Hi, class. Okay, so chapter 8, we're going to be talking about risk and return. So let's dive into that. In this chapter, we're going to understand the meaning and fundamentals of risk, return, and risk preferences. We're going to be able to describe procedures for assessing and measuring the risk of a single asset and discuss the measurement of return and standard deviation for a portfolio and the concept of correlation. We're also going to understand the role that correlation plays into constructing an effective portfolio. We're going to review two types of risk and the deviation and role of beta in measuring that relevant risk of both a security and a portfolio. We're also going to explain the capital asset pricing model, the CAPM, its relationship to the security market line, the SML, and the major forces causing shifts in that SML. So let's begin with a portfolio. What is that? It's a collection or group of assets. What is risk? That's a measure of uncertainty surrounding that return that an investment will earn. And what is return? That's a total rate of return, a total gain, loss expected on an investment over a given period expressed as a percentage of the investment's value. It's calculated by dividing the asset's change in value plus cash distributions during the period by its beginning of period value. What is return? It's calculated by this equation here in 8.1. So RT is the total return during that period, where PT is the price of the asset at that time, and then PT minus 1 is the price of the asset at time T minus 1. And then CT is the cash flow received from the asset during that period of PT. So think of PT as like if we're thinking about months, PT is June and PT minus 1 is going to be May. So what's the difference between those two time periods, those 2 months? So it's now versus, minus the previous month's value, if that is what T is in. It could be in years as well. So here's an example. Robin wishes to determine the return on two stocks she owned in 2019 for McDonald's and Walmart. At the beginning of the year, McDonald's stock traded for $170.84 per share, and Walmart stock was valued at $90.69. During the year, McDonald's paid $4.73 per share in dividends, and Walmart paid their dividends out of $2.12. At the end of the year, McDonald's stock was worth $196.38 and Walmart stock was sold for $117.80. So let's substitute those values into our equation 1 to calculate the annual rate of return for each stock. So she made money on both stocks in 2019. On a percentage basis, her return was higher on that Walmart stock through her profit in dollar terms. It was $30.20 on McDonald's stock versus $29.23 for Walmart. So McDonald's, the 196.38 minus the 170.84. So again, remember T. So that's our sale at the end of the year. Our beginning was 170.84 plus that 473 divided by that initial price. So that's a 17.7% for McDonald's. Walmart was 117.80 minus 90.69 plus 212 divided by that initial price of 90.69 of 32.2%. So again, looking at return, what's the total rate? We could look at the realized return, which is a historical return, or the expected return. It's expected to generate in the future, composed of that risk-free rate plus a risk premium. So here are some historical returns on some selected investments from 1900 to 2019. So on Treasury bills, our average nominal return is 3.7. So that's what they tell you. And average real return is 0.9%. Treasury bonds, 5.3%, whereas the average real is 2.5. And then common stocks, 11.5, where the average real is 8.5. We also need to look at our risk preferences. So risk seeking, that's our attitude towards risk, where our investors are either preferring investments with greater risk or maybe they have lower expected returns. Risk neutral, we've got an attitude where we could choose the investment with the higher expected return rate, regardless of how risky it is. And then risk adverse. This is the attitude where we're going to increase our expected return as compensation for that increase in risk. So we're not all grabbing for risk like we are in risk seeking. We need to perform the risk assessment of a single asset. We can use scenario analysis. So that uses several possible alternative outcomes or scenarios to obtain a sense of the variability among those returns. A range is a measure of the asset's risk, which is found by subtracting the return associated with the worst outcome from the best outcome. So here's an example. Norman Company, a manufacturer of custom golf equipment, wants to choose the better of two investments, A and B. Each investment requires that initial outlay of $10,000, and each has a most likely annual rate of return of 15%. So far, so great. Everything is equal. Management estimates returns associated with each investment's pessimistic or worst and optimistic or best outcomes. So we're going to look at a table that lists the three return estimates for each asset and the range between the best and worst outcomes. So here is that asset A and B. An initial investment is again the same. And then we have the annual rate of return. So most likely they are generating at 15%, each of them. We can look at the pessimistic and optimistic for both of those with that specific range. So asset A appears to be less risky than asset B because its range is only 4% and it's less than the range of 16% for B. The risk-adverse decision maker would prefer A over B because A offers the same most likely return as B with the lower risk. So again, you can see pessimistic range 13 to 17%. That's the range of 4%. Pessimistic for B is 7 to 23. Optimistic. So that range there, the difference is 16%. With risk assessment, we have to look at probability distribution. So probability is a chance that an outcome will occur. We can look at discrete probability distribution. So this lists out every possible value of some random variable along with the probability of each of that outcome. We can look at a bar chart. This is a visual representation of a discrete probability distribution, or possibly use a histogram, which puts historical data into those bins and shows us the relative frequency of those data points in each bin. So here are some bar charts for specific returns for A. Again, that was 13 to 17% there. So again, it most likely will be that 15%. So that's why 50% is occurring here. And then the other 50% is made up of the 13 and the 17. Same with B. They had a 7 and a 23. So again, both of those are at a quarter percentage chance occurring, where the most likely at 50% is occurring at 15%. So Norman's Company's past estimates indicate that the probabilities of the pessimistic, most likely, and optimistic outcomes are 25, 50, and 25. So the sum has to equal 100%, which those do. The probability distribution must assign a probability to every possible outcome such that no other outcomes are possible. Here is a histogram for Coca-Cola and Google. So we can see Coca-Cola here with their histogram, and we see the bell curve here. So again, the most occurring was 0 to 5% return. That occurred about 44-ish% of the time, maybe 45%. And then after that, it was the next highest was -5 to 0%. So that would be a loss. There's no return there. And that occurred about 35% of the time. And here is Google with their median number there at the top of the bell chart, looking at 0 to 5% monthly return occurring about 30% of the time. This is a little bit spread out more than it is for the Coca-Cola. But you can see that at some point, maybe 1% or 2, they had above 30% in returns, which is fantastic. Is it ever possible to know for sure that a particular outcome can never happen? The chance of its occurrence basically 0%. In the 2007 bestseller, The Black Swan, The Impact of Highly Improbable, Nassim Nicholas Taleb argues that seemingly improbable or even possible events are more likely to occur than most people think, especially in the area of finance. The book's title refers to a long-held belief that all swans were white, a belief held by many people until a black variety was discovered in Australia. So Taleb reportedly earned a very large fortune during the 07 to 08 financial crisis by betting that financial markets would plummet. So again, with those probability distributions, we could also look at a continuous probability distribution. This shows all possible outcomes and associated probabilities for a given event. We also need to look at variance and standard deviation. So we're looking at our deviations here. So variance is a measure of the dispersion or volatility of an investment's return about its average return. And the standard deviation is the square root of variance. Hence why it's not up, it doesn't have a 2 as its exponent like the variance does. It is the square root, so that gets rid of that second exponent power. Here is our average return equation in 8.2. So our J right here is going to be the sum for the J outcome, whatever that might be. The PRJ is the probability of occurrence for that specific outcome. N is the number of outcomes considered, where J is equal to 1, so it starts at 1. And this is the sum of all of those occurrences happening. The variance and standard deviation is an investment average return that can be estimated by taking the arithmetic mean from a series of n historical returns. So here is that equation. We're going to look at a table that presents the average returns for Norman Company's assets A and B. One column gives the probability of each outcome, the PRJ, and column 2 gives the return associated with that outcome of RJ. And each average return is about 15%. So here is that table that shows what the probability is that we calculated and saw from earlier. And then those specific returns, again, we're looking at the ranges, so 13 to 17 for A, 7 to 23 for B. And then we can see what the average return is going to be at 15%. And that's by adding up all of those figures. So 7.5 plus 4.25 plus 3.25 is going to equal 15. The same thing with B. With an estimate of the average return in hand, we can calculate then the variance and the square root, the standard deviation. So here are the equations for the variance and the standard deviation of returns. When the J outcomes and the probabilities are known, we can use those to plug them into these equations here. And the more common situation of knowing neither the full list of possible outcomes or their associated probabilities, we could still estimate the variance and the standard deviation using these specific formulas here. We're going to look at a table that presents the standard deviations for Norman Company's assets A and B based on our table from before that we just looked at. So the standard deviation for asset A is going to be 1.41%, which we see here. And the standard deviation for asset B is 5.66%, or here. So this clearly reflects B's higher volatility. Again, with that huge range between the 7 and the 23%, that shows that it is more risky. So that's why we see a higher number here for that standard deviation. We could look at historical returns and risk. So investments with higher returns usually have higher standard deviations. A symmetry probability distribution resembles that bell-shaped curve that we looked at earlier for Coca-Cola and Google. That's a normal probability distribution. But all stocks are not created equal. So we're going to look at a table that shows that the stocks are riskier than bonds, but are some stocks riskier than others? It's obviously a huge yes. A recent study examined the historical returns of large stocks and small stocks and found that the average annual return on large stocks over the previous century was 12%, while small stocks earned 16.6% per year on average. So the higher return on small stocks came with a cost. That standard deviation return was a whopping 31.9%, whereas the standard deviation on large stocks was only 19.9%. So here's that table with the historical returns and standard deviations on different investments from 1900 to 2019. So again, the treasury bills that we looked at before, the average nominal return was 3.7%, where our standard deviation was 2.9%. The coefficient of variation was 0.78. The treasury bonds came in at 8.9% standard deviation with a coefficient of 1.68. And the common stocks we're at 19.7% standard deviation with a variation coefficient of 1.71. So here's that bell-shaped curve. And what this is saying is that our return percent is based within these specific deviations. So one standard deviation either way from the middle R occurs about 68% of the time. Within two standard deviations on that bell curve, we have 95% occurring with that return. And then within 3% or three standard deviations, that return is occurring 99.7% of the time. So anywhere between the three marks, you will most likely get a return 99.7% of the time underneath that bell curve, whether it is positive or negative return. So using the data in table 8.5, we're going to assume that the probability of returns on stocks and bonds are normal. We can surmise that 68% of the possible outcomes would have a return ranging between negative 8.2% and 31.2% for the stocks, between 3.6 and 14.2% for bonds. 95% of the possible returns would range between negative 27.9 and 50.9 for stocks, and for bonds, it's negative 12.5 to 23.1%. So the greater volatility of stock returns is clearly reflected by having that wider range of possible returns for each level of confidence, whether it's at 68% or 95%. We also need to look at the coefficient of variation. I know we mentioned that in the table, so this is trading off risk and return. So what is that coefficient? It's a measure of relative dispersion that is useful to compare assets with different average or expected returns. And it's given by this equation here, where CV, the coefficient, is equal to the standard deviation divided by R. So the higher coefficient of variation means that an investment is more volatility relative to its expected return. So let's use some of our equations, some of our numbers from table 8.4 and expected returns from 8.3 into our assets A and B for Norman Corporation. So we can find that the coefficients of A and B are going to be 0.094, which is 1.41% divided by 15, and 0.377 for B of 5.66 divided by that 15. So asset B has the higher coefficient of variation. Another example, Marilyn Ansborough is reviewing stocks for inclusion in her investment portfolio. The stocks she wants to analyze include Danhus Industries, a diversified manufacturer of pet products. One of her key concerns is risk. As a rule, she only wants to invest in stocks with coefficients of variation below 0.75. So she's gathered price and dividend data for Danhus over the past 3 years, and she plans to calculate the coefficient of data of variation using that data with the limited historical sample. So in year one, the stock price beginning was 35, ending 36.5. The dividend they paid out was $3.50. In year two, 36.5 beginning, 34.5 ending, they still paid $3.50. In year three, they started out with 34.50 and they ended at 35. The dividend they paid was $4 then. So let's substitute price and data for equation 8.1 to find what that return is. So in year one, it was the ending minus the beginning plus the dividend divided by that beginning price. So it's 14.3% in year one. Using the same calculations for year two and three, given that data, we see two was 4.1% and year three was 13%. We can use those figures to get the average return by adding up 14.3, 4.1, and 13 and divide it by 3 to get 10.5. So the average return is 10.5%. So let's use those figures to get our standard deviation. So 14.3 minus 10.5, 4.1 minus 10.5, 13 minus 10.5, and those are all going to be squared. Then we're going to divide that by 3 minus 1, or 2. So then we come out with 14.44, 40.96, 6.25. We're going to take the square root of that total, and we're going to come out with 5.6% as our standard deviation. So now let's calculate that coefficient of variation. So we have 5.6% divided by 10.5%, which was the average rate of return, and we get 0.53. So we know that 5 8.3 is well below that 7.5 that she wants. So she concludes that this stock would be an acceptable investment to her. We also need to look at the risk of a portfolio. So there's an efficient portfolio that maximizes return for a given level of risk. The return is based on the weighted average of the returns from which it's formed. And this is where we have our equation 8.6, where we have the sum of all of our percentages of total dollar value invested times our return. So an example using that equation, we're going to look at James, who purchases 10 shares of JP Morgan at a price of $90 per share. So his total investment is $900. He also buys 27 shares of Medtronic at $100 a share. So his investment at Medtronic is $2,700. Let's combine those two. So his total portfolio is worth $3,600. And of the total, 25% is invested in JP Morgan, which is his $900 divided by 3,600, and 75% is invested in Medtronic, or 2,700 divided by 36. So his W1, which was his percentage of the portfolio's total dollar value invested in his asset, is 0.25, and W2 is 0.75. So let's add those together and we get 1.0, which is what a percent should equal, 100% as your portfolio. So here is that average return on a portfolio again. This one, we are looking at the return. So that's W times R. So in table 8.6, panel C is going to apply monthly return series in panel A and the average returns to panel B in equation 8.4 to find the respective standard deviations, which tell us about month-to-month fluctuations in the return series. So let's take a look at that. So that is this table here that shows the returns for JP Morgan and Medtronic. So you can pull this up. So as you might have guessed, that portfolio standard deviation equals a weighted average of the standard deviations of JP Morgan and Medtronic. So that intuition is flawed. The standard deviation for JP Morgan is 6.5%, and Medtronic is 2.8%. A simple weighted average of these two calculations might say that 25% weight for JP Morgan and 75% Medtronic would say that the standard deviation is 3.7, which is 0.25 times 6.5, and add that to 0.75 times 2.8%, but that's wrong. Panel C is going to show the step-by-step standard deviation calculation, which indicates that the standard deviation is just 1.7% for his portfolio. And that's remarkable because this is less volatile than other asset, either one in the portfolio. So basically, to say it differently, Medtronic has less volatility, so 2.8 versus the 6.5 of JP Morgan. So the safest way to form a portfolio of these two assets is to not form a portfolio at all and just invest everything in Medtronic. But we don't want to do that because the portfolio that invests 25% in JP Morgan is actually less volatile than Medtronic is all by itself. So carefully scan those numbers in the last column. It makes it clear. So the portfolio's highest and lowest returns are 5.3 and negative 0.4. So in 7 out of 10 months, the portfolio's return is between 2 and 3.2%. And only in 1 month is the portfolio return going negative. So the individual stock returns vary a great deal more than having them combined. Here is part B for the individual and portfolio average returns here. So JP Morgan was 3.4, Medtronic was 2.1, so the total portfolio is 2.4. And then here are the standard deviations as well for both of them and the portfolio itself. So again, if you invest still everything into Medtronic, you're looking at 2.8%, which is still more volatile than the portfolio is together at 1.7%. We need to look at correlation. This is a statistical measure of the relationship between any two series of numbers, whether it's positively correlated, so two series are moving in the same direction, or they're negatively correlated, so they're moving in opposite directions. So here's an example of a portfolio. So again, this is a negatively, based on this line here, because it is downward sloping. So as we get higher on our monthly return for Medtronic, we are going negative on JP Morgan, and vice versa. As we're going higher on JP Morgan, we are going lower on Medtronic. Here is a positive one for JP Morgan Chase and Morgan Stanley. So as we are going higher on JP Morgan Chase, we're going higher on Morgan Stanley. We can also look at the correlation coefficient. This is the degree of correlation between those two series. So positively, perfectly correlated is a correlation coefficient of +1. A perfectly negative correlation is a -1 correlation. Uncorrelated means that the correlation coefficient is 0. They don't have any interaction whatsoever. So mathematically, the correlation coefficient between two stocks is calculated using the n number of historical observations. So you can find that here in our equations 8, 8, and 8, point A, which is just the sum of all of those. We need to look at diversification and efficient portfolios. So to reduce our portfolio risk, it's best to diversify by combining or adding to that portfolio assets that have the lowest possible correlation. So again, we saw that before when we looked at Medtronic and JP Morgan. Having that diversification lowered that risk. Combining assets have a low correlation with each. They can sometimes simultaneously increase that portfolio's return while decreasing that standard deviation. So whenever assets are perfectly negatively correlated, some combination of the two assets exists that the returns are risk-free. So here's the correlation coefficient for JP Morgan and Medtronic. So their correlation coefficient is -0.62. So again, it is a negative correlation. This is part 2 of the table. This is JP Morgan and Morgan Stanley that we saw that positive correlation. It shows 0.94. So that is closer to +1 than the -0.62 is to -1. So this is more of a better diversification portfolio that may be needed to be changed out and take Medtronic out than it is to keep Medtronic and maybe add in Morgan Stanley. We have already seen that the average return on a portfolio depends on the average return of the stocks in that portfolio. So that standard deviation depends not only on the standard deviations of the stocks, but also on how those stocks are correlated with each other. So if the portfolio consists of two stocks, the formula for the standard deviation of a portfolio is going to be the equation 8.9. In table 8.6, walk through the calculation of the standard deviation of a portfolio consisting of 25% JP Morgan and 75% Medtronic. But we can use equation 8.9 instead, summarizing what we already know about the stocks. So the correlation between JP Morgan and Medtronic, again, was 0.62, and it was negative. So this shows you how we have the standard deviation for the entire portfolio. Confirming the result in that example from before, the standard deviation that invests 25% in JP Morgan and 75% in Medtronic is just 1.7%, which is less than the standard deviation of each stock on its own. So here are the average return and standard deviations for portfolios of JP Morgan and Medtronic. And these are the standard deviations here. So this is what our portfolio is going to look like. So if you have 100% Medtronic, your portfolio standard deviation is about almost 3%, and your average return is about 2%. 100% JP Morgan has about 6% standard deviation, maybe a little bit, 6.5 or so. We looked at that, it was like 6.4, I think is what it said. And then when we have 50-50, we see that the portfolio standard deviation is about 2.7. And our average return rate is about 2.7 maybe as well. Um, so basically, you just look at seeing how they correlate together. Table 8.9 presents historical returns from three different assets, X, Y, and Z from 2017 to 21, along with their average returns and standard deviations. The assets are similar in that they each have the same average return of 12% and the same standard deviation of 3.16%. The returns of X and Y are perfectly negatively correlated, so that is a perfect -1. When X enjoys its highest return, Y experiences its lowest return, and vice versa. The returns of X and Y are perfectly positively correlated. So that is a +1. They move in the same direction. So when the return on X is high, so is the return on Z. The return for X and Z are identical. Now let's consider what happens when we combine these assets to form different portfolios. So here is that table 8.9 for portfolios X, Y, and XZ. So we're going to combine XY. These are the negatively correlated assets. So the return on this portfolio is 12% all the time. So it completely eliminates risk because each and every year it's going to return 12%. So whenever assets are perfectly negatively correlated, some combination of the two assets exists such that the resulting portfolio's returns are risk-free. So you can see that here, down here, the portfolio returns for XY is 12% here. Standard deviation is 0, is always at 12%. So there are no other deviations whatsoever. And you can see that based on these calculations, always equaling 12%. Whereas X and Y together, yes, their average is at 12%, but they each have a standard deviation of 3.16. So that ranges and it changes every year. Now, what if we do XZ? They combine equal portions of assets X and Z. Those are the positively perfect correlated assets. So they have the same standard deviation as well, 3.16, because they always move together. The standard deviation will be a simple weighted average of the standard deviation of X and the standard deviation of Z. So was the case with XY, the average return is also 12%. So because both portfolios provide the same average return, but XY achieves that expected return with no risk, XY is clearly the preferred by risk-averse investors over XZ. So in summary, the lower the correlation between asset returns, the greater the risk reduction that investors can achieve by diversifying. So consider two assets, low and high, with the characteristics described below. So low has an average return of 6% and a risk or standard deviation of 3%. High has an average return of 8 and their standard deviation or risk is 8. So obviously asset low offers a lower average return than high does, but it's also less volatile. So we've seen that these portfolios with two assets will always have an average return that falls between 6 and 8%. So the correlation between them doesn't affect that average return, but it does affect the portfolio standard deviation. So we look at three specific scenarios. The first one is returns on low and high that are perfectly positively correlated, that are uncorrelated, and that are perfectly negative correlated. So whether the correlation between them is +1, 0, or -1, a portfolio of these assets has to have an average return between 6 and 8%. That's why the line segments at the left in the figure 8.6, which are here, all range between 6 and 8%. So if a portfolio is mostly invested in low with only a little money invested in high, the portfolio return will be close to 6. If more is invested in high, the portfolio return will be closer to 8. So you can see that here with the range of standard deviation. But the standard deviation depends critically on the correlation between low and high. So when low and high are positively correlated perfectly, it can be said that the portfolio deviation must fall between 3% and 8%. So 3% is low standard deviation and 8% is high standard deviation. So as the correlation becomes weaker and the coefficient falls, investors can find that they can form portfolios of low and high with deviations that are even less than 3%. So portfolios that are less risky than holding low all by itself. So that's why the line segments at the right, they vary. So in the special case when low and high are perfectly negatively correlated, it's possible to diversify away from all risk and have a portfolio that is risk-free, which is why we see here it goes down to 0, and it could potentially go lower. Now let's move on to capital asset pricing model, or CAPM. It's a theory that links risk and return for all assets. So total risk is the combination of a security's non-diversifiable risk and their diversifiable risk. So let's talk about those. Total security risk is a combination of those two. So diversifiable risk is the portion of assets that are unique to that asset and can be eliminated through diversification. It's also called unsystematic risk, idiosyncratic risk, unique risk, or maybe even firm-specific risk. You might see all of those different terms. They all mean diversifiable risk. Non-diversifiable risk are those risks attributable to market factors that affect most, if not all, firms. They can't be eliminated through diversification. That is called either market risk or systematic risk. So here is an equation of risk reduction. So we see diversifiable risk and non-diversifiable risk, whereas the total of that line there at about 7 or so, that total is total risk here. So the model, the CAPM model links non-diversifiable risk to expected returns. We have a beta coefficient. So this is a relative measure of that non-diversifiable risk, and it's an index of the degree of movement of an asset's return in response to change in that market. The market return is the return on the market portfolio of all traded securities, and mostly used as the S&P 500 or similar stock index as the market return. So that beta coefficient, that's deriving beta from return data. It's estimating the characteristic line. So the slope of the line is beta. So here is an example of beta derivation for Bank of America and Pepsi. So we can see the slope of Bank of America, the beta slope is 1.73, and for PepsiCo, it is 0.66. So let's interpret that beta. The beta coefficient for the entire market across all beta, across all stocks equals 1.0. So all other betas are viewed in relation to that specific value. So they may either be positive or negative, but positives are usually the norm. The majority of beta coefficients fall between 0.5 and 2.0, which we saw with Bank of America and Pepsi. So portfolio betas are interpreted in the same way as the betas of individual assets. We are just summarizing everything. So here's a table of selected beta coefficients and their interpretations. So anything above 0 is going to move in the same direction as the market. So it's twice as responsive for 2.0. 1.0 is the same response as what the market does. It's going to do the same. And then 0.5, it's only going to be half as responsive as what's going on in the market. At a 0 beta, it's unaffected by what the market does. When it's in negatives, it's going to move in the opposite direction to what the market's doing. So at a point -5, it's only going to be half as responsive as what the market does. In a -1 manner, it's going to be the same response in the market, but it's just going to be the negative direction. And a -2 is twice as responsive as what the market is doing. So here are coefficients for betas of different types of stocks from April of 2020. So we saw here all of them are above 0. So that's always a good thing. So we can see that a lot of them are moving with the market in a positive direction. Netflix appears to be the closest at 0.97 to a word for word, movement for movement with what the market does. So here's a personal example. Mario Ostino is an individual investor. He wants to assess the risk of 2 small portfolios that he's considering. The first one is called the necessities, which includes investments in 5 stocks that were listed in table 811, which are these here: Costco, Exxon, Pepsi, Starbucks, and Walmart. His high-tech portfolio also contains 5 stocks: Amazon, Apple, Intel, Microsoft, and Qualcomm. So in each portfolio, he's going to invest the same proportion, 20% in each of those 5 stocks to equal 100% in his portfolio. So let's use the equation 8.11 and the betas from that table 8.11 to calculate the beta of each of those portfolios. So his necessities. So again, 20% times their beta. We're going to get a total beta for the portfolio of 0.77. For his high-tech beta, his total is 1.13. So the necessities portfolio beta is 0.77 compared with the 1.13 beta of the tech. They may not seem too different, but the tech portfolio is almost 47% more risky than the necessities portfolio. And you get that by taking 1.13, subtracting 0.77, and dividing that by 0.77. So he's got to find a way to assess how much extra return he should anticipate if he chooses to hold the riskier portfolio. So with that, we're going to look at the CAP-M equation. So that's in 8.12 here, where our J is the expected return. Our F is our risk-free rate of return. It's commonly measured by a U.S. Treasury bill. The BJ is the beta coefficient of our non-diversifiable risk. And RM is our expected return on the market portfolio. Plus, we're going to add in that risk-free again, rate of return. We're going to take that out of our market portfolio return. So again, that risk-free rate of return is the required return on a risk-free asset, typically a 3-month U.S. Treasury bill. Those are called T-bills. They are short-term IOUs issued by the government, considered a risk-free asset. Historical risk premiums are calculations subtracting the historical U.S. Treasury bills average return from that historical average return. So here is an investment like stocks. The risk premium we're taking out at 3.7%. So we find the stocks risk premium 7.8 and Treasury bonds is 1.6. So let's go back to Mario. What should he expect from that high-tech portfolio with a beta of 1.13? The risk-free rate of return is 2%. He expects risk premium to be just 4%. How much lower? Much lower than its long-run historical average. So that means the expected return on the market portfolio is 6%. So after substituting that information in, we can find that the expected return on the high-tech portfolio is 6.5%. The market risk premium of 4%, which was that 6% minus 2%, when adjusted for the risk beta, results in that premium for that high-tech portfolio of 4.5%, which is 6.5 minus 2. So the risk premium, when added to the 2.2% risk-free rate, results in that 6.5% required return. So all things other being equal, the higher the beta, the higher the required return. The lower the beta, the lower the required return. So let's look at a graph, the security market line, or the SML. This is a graphical depiction of the CAP-M model. It shows how the expected or required return in the marketplace depends on its beta. And we can plot the SML by connecting 2 points for which we already know the expected return and the beta. So the first point is the risk-free asset, which has a return of 2% if we're talking about that, and the beta of 0 because it has no risk. It doesn't move when the market moves. So the second point is the market portfolio, which has a return of 6% and a beta of 1. So let's plot them in our 8.9 figure here. So we see 0 and 2 for RF. The line has an intercept of 2%, meaning the security with no risk earns a 2% return. So the slope of the line is 4% because that is equal to the risk premium, which was 6 minus 2%. So we can see that it goes up 4 to 6%. The beta at 1 is the market risk premium of 4%. So our next intersection is 1, 6. And then after that, at 1.5, the risk premium is 6%. So then it goes up to 8 there. And we can see that the slope of the line is 4%. The figure highlights that there's a trade-off between the security's non-diversifiable risk and its required return. And for any beta, that the figure makes it easy to find the associated expected return. So again, at 1.5, it's got a required return of 8%. So the risk premium, again, is at 6%, which is higher than the market's risk premium. That is asset Z's risk premium. The general principle illustrated here is that the risk premium for an asset with a beta greater than 1 will be greater than the risk premium of the market. Whereas when the beta is below 1, it's going to have a risk premium that's less than what the market's risk premium is. So again, here is that that you can see here, the SML is that line with the market risk premium and asset Z's risk premium. So we can see that asset Z has a higher risk premium than the market. So there are shifts in the security market line that occur. It could be changes in inflationary expectations. So with that, we might have to, deviate our SML line to see how inflation affects that risk-free rate. And by doing that, we are going to be adding I, or inflation. So changes in inflationary expectations result in a parallel shift in the SML in the direct response to the magnitude and direction of that change. So inflation directly affects the SML line. So if we use the preceding example, the cap M for asset Z was 8%, assuming the risk-free rate of 2% includes 1% real rate of interest and a 1% inflation rate, or IP, then we can see that the risk-free was 1 plus 1 equals 2. Now assume that economic events have resulted in an increase of 3% in inflationary expectations, raising the inflation premium to 4%. So as a result, we're going to see everything increase by 3%. So the new risk-free rate is now 5% because we're rising from 2 to 5 to increase that extra 3% in our inflation. So that makes our return also increase for the market. So that's going to also increase 3% from 6 to 9%. And when we substitute those values in using asset Z's beta of 1.5, we're going to find that their new required of return also increases by 3%. So comparing the new inflation of 11% to the original 8%, we see the change in 3% equals exactly the change of inflation premium. So the same 3% increase results for all assets, which shows that shift here. So everything just shifts parallel upwards 3% to account for that 3% in inflation. So again, that's what this states here, saying that the required return on all assets rise by 3%. Inflation rises from 1 to 4. The risk-free rate then rises from 2 to 5, and the market return increase from 6 to 9. So the important lesson that's here is that changes in inflationary expectations are going to cause that corresponding change in the return of all assets. It's going to be a parallel shift of the SML. We could look at changes in risk aversion. So the slope of the security market line reflects the general risk preferences of investors in the marketplace. Most investors are risk averse. They're not willing to grasp onto those riskier pieces. So if they become even more risk averse, the slope of the SML is going to become steeper as they demand a higher return for any risk level. And changes in that risk aversion and the slope will result in changing preferences of investors, which generally stem either from economically, politically, or social events. So if we take a look at the SML that we looked at before in 8.9, the risk-free rate was 2% with the market return of 6%. For Z, we had market risk premium. They had a required return of 8%. The beta was 1.5. So assume that economic events have made investors more risk averse. They're now demanding a higher risk premium on that market portfolio. So our risk premium is going to rise to 7%. So our market return is going to increase to 9%. So graphically, this would show that the SML is going to pivot upward and the return on all risky assets will increase. So you can see that pivot here on how that changes. So we can calculate the new required return for asset Z with a beta of 1.5 by using the cap M equation. We see that we get 12.5%. So although asset Z's risk as measured by their beta didn't change, its required return has increased because that increased risk aversion reflected in the market risk premium. So the greater risk aversion results in higher required returns for each level of risk. A reduction in the risk aversion causes the required return for each level to decline. And again, here's that chart again. So some comments on the cap M. So to estimate the stock's beta, analysts are generally going to use historical data. The estimated beta may or may not actually indicate the future variability of returns. And users of betas usually make subjective adjustments to historically determined betas to reflect those expectations of the future. And studies have supported that the CAPM's main prediction that stocks with higher betas should have higher returns on average. Studies have uncovered other characteristics that appear to influence returns besides data or beta only as the CAPM predicts. So over time, smaller firms, for example, tend to earn higher returns than larger firms do, even after taking into account that the smaller firms have higher betas. And despite those limitations, the CAPM sees widespread application in corporations that use the model to assess the required returns that their shareholders demand. Most large firms are going to rely on CAPM to estimate their costs of capital, which in turn has a major impact that the investments the firm is going to choose to undertake. So let's review our chapter. What did we learn? We learned the fundamentals of risk, return, risk preferences, how the total rate of return is the sum of those cash distributions like interest or dividends, plus the change in asset value. Returns vary over time. There's different types of investments. Investors can be risk averse, most are, risk neutral, or risk seeking. A risk averse decision maker requires a higher expected return on a more risky investment. We also looked at risk is related to uncertainty about the return that an investment will provide. So we can use scenario analysis and probability distributions to assess that risk. The range, standard deviation, and the coefficient of variation can measure that risk quantitatively. The return of a portfolio is calculated with the weighted average of returns on those individual assets from which it's formed. And our standard deviation depends on the standard deviation of returns on each of those assets, as well as the correlation between the two. Correlation, we learned that that's a statistical relationship between any two series of numbers. It can be positively correlated, negatively correlated, or uncorrelated completely. At the extremes, the series can be perfectly positive, +1, or perfectly negative correlated, -1. We looked at how diversification involves combining assets that are less perfectly correlated to reduce our risk. We also looked at a range of risk in the two asset portfolio. It depends on the correlation between the two of them. If they're perfectly positively correlated, the portfolio risk will be between the individual's assets risk. If they're perfectly negative correlated, that the risk is between the risk of the riskier asset and zero. An efficient portfolio is one that provides the highest expected return for any risk level. The total risk of a security consists of non-diversifiable and diversifiable risk. That diversifiable risk can be eliminated through diversification, but non-diversifiable risk is the only risk that the market rewards with higher returns, and that's measured by that beta coefficient that we calculated. It's also a relative measure of the relationship between the asset return and the market return. The beta is derived by finding the slope of the characteristic line. It explains that historical relationship between the asset's return and the market return. And it's a weighted average of betas of the individual assets that it includes. We looked at the CAPM and how the beta relates an asset's relative risk to the market to the asset's required return. We can look at the graphical depictions of the CAPM in the SML, which shifts in response to either inflation or investor risk aversion. So changes in inflation, expect parallel shifts in the SML. If there's increasing risk aversion, expect a slope becoming steeper. We also looked at decreasing risk aversion and how that reduces the slope of the SML. But although it has some shortcomings, the CAPM provides a useful conceptual framework for evaluating and linking risk and return. If you guys have any questions about risk, return, calculating CAPM, any of that, any of your homework, please feel free to hop on to the Zooms that I have for office hours or send me an email, whatever works best for you. You don't have to show your picture on the Zoom call if you don't want to, but I'm more than welcome and more than happy to help you out in any way possible to complete and help you understand the concepts. So again, any questions, please feel free to reach out. We will be looking at chapter 9 next. Thank you.